Well, good afternoon, everybody. It's afternoon here, and nice to be back with you to try to bring you up to date on what's happening here at Hugh Johnson Advisors and what we're thinking about when it comes to the economy and the financial markets. It's really hard to talk about the financial markets and even to talk about the economy unless we unfortunately have to sort of refer to what's going on in Washington. The events in Washington are going to have an impact on the economy and an impact on stock prices and the financial markets generally as we move forward. You know, we've just gone through a period where the Trump administration has suffered a fairly significant setback when they could not get any agreement on health care reform through the Senate, and it looks like they won't get anything done on health care anytime soon. Most of us, many of us, have taken that as fairly bad news, news that the Trump administration is having a struggle to get any of its agenda passed, even though they did get, of course, their nomination to the Supreme Court passed, Gorsuch. And they also have had a lot of regulations that have been eliminated, which is good news for business. But generally speaking, we'd have to say that on balance, the Trump administration has not had very much success in getting anything done as far as its agenda goes. In some ways, I think there's some good news, and this is perhaps being a little bit Pollyannish, but it's good news in the sense that, first of all, they can now turn their attention to what really counts for investors, and that's, of course, their tax and spending policies, their economic policies. They've got a lot to get done before that. They've got to get the 2018 budget done. That's very controversial. The debt ceiling has to be passed. Trying to avoid shutting down the government. You know how we go through those struggles every now and then. That has to get done first. But we obviously now have a somewhat clearer path towards tax and spending policies getting approved by the Congress. What they plan to do is they're behind closed doors in many senses of the word. Mr. Cohn and Mr. Mnuchin from Trump's administration are behind closed doors with a number of representatives of the House of Representatives and the U.S. Senate, to include House Speaker Ryan as well as Mitch McConnell from the Senate. They're working on trying to put together some sort of a philosophical proposal which they'll share with all the members of Congress, which is a good idea, both Democrats and Republicans, during the month of August, and then they plan to roll out their proposed tax and spending plan in September. I think that as the time goes by, I think we're really looking at the very best, getting the approval of a tax and spending plan or policy by, say, mid-year 2018. It might be retroactive to the beginning of 2018. So they're going to start to work on that, and that's important. And the reason it's so important right now for the financial markets is that as we really look at the numbers, first of all, we're still in the camp that says we have further to go in the current cycle, the stock market, business or economic interest rate cycle, the performance of the financial markets, the performance of very important monetary and economic variables says we have further to go in the current cycle. But that's the good news. The bad news is, as we've mentioned so many times in the past, is that there's not a lot of upside potential for the market, particularly because the Federal Reserve will be raising interest rates. Interest rates across the board in response will be rising. And secondly, the economy is likely to grow at a very anemic or somewhat slow pace of about 2.2, 2.3, 2.4% in 2017 and 18. And it's hard to make the case for very good or strong earnings when you have an economy that's growing that anemically. So one of two things has to happen. Either the economy has to grow more strongly, and maybe we get tax cuts that are significant enough, spending increases on spending on infrastructure that are strong enough to get the economy doing better than that 2.3, 2.4%, which would give us the kind of earnings that will justify or support higher stock prices. Otherwise, it's very hard to make the case for higher stock prices. Or, and this is pretty important, the consensus forecast for earnings, which is significantly higher than I have it now, or that most of us as forecasters have it. This consensus forecast is right and we're wrong. If that's the case, then we again can make the case for higher stock prices. So we're going to be watching carefully on anything that has to do with earnings, anything that affects earnings, because we do need higher earnings in order to justify or support the case for higher stock prices. Right now, in response to our general view that we have further to go in the cycle, we've maintained a pretty meaningful allocation to equities. That's worked so far. We're looking for those signs continuously that are telling us, that would tell us that we are either at the end or near the end of the current cycle. You know, it's been a long cycle. We're at 100 months now. That's very, very long, comparatively speaking, to other cycles in the post-war period. So it's important for us to be on our toes, looking for those financial market signals, those monetary and economic signals that tell us that there might be some difficult times ahead. And under those conditions, we want to reduce everybody's exposure to equities and try to preserve capital, which is so important in a down market. That's what we think is probably the key or the secret to providing you the kind of long-term performance that you really deserve. So these are difficult times. Again, it's difficult because it's been a long cycle. It's difficult because although the monetary and economic variables continue to be positive, they're starting to give us a little bit of a problem. We've seen a slowdown in bank lending, a slowdown in money growth, a slowdown in liquidity, the kind of stuff that we need to drive the economy and the markets. So it's a little bit unnerving, but we still are staying with it with a meaningful allocation to equities, but again, being very much on our toes. Thanks very much. We're going to watch the political situation in Washington as it unfolds. We're going to watch very carefully what it looks like, prospects for tax cuts, tax reductions, both for individuals and corporations. We're going to watch very carefully the spending policies as they unfold for 2018. Will that stimulate the economy and provide us a stronger growth in the economy and earnings? We're going to watch all these variables and try to make really good decisions. Right now, everything looks fine. Really appreciate you once again joining me for an update on where we think things are going, and look forward to talking to you in about a month. And again, thanks very much for the confidence you continue to show in Hugh Johnson Advisors. We're working really hard to deserve that confidence. So thanks again, and look forward to talking to you again in a month. And please, again, as I say always, feel free to call myself, Dan Nolan, the president of Hugh Johnson Advisors, any one of us at Hugh Johnson Advisors. We look forward to talking to you and sharing your thoughts about what's going on in this world of ours and any concerns that you might have. Questions, of course. Thanks very much, and look forward to seeing you and talking to you again.